What's going on, everybody? Happy New Year. Happy New Year. Happy New Year. I appreciate everybody for tapping in this year to another episode of the Trade for Yourself podcast. The goal is for us to have another strong year of learning, another strong year of building wealth and getting closer to where we need to get to. So again, I appreciate you all for tapping in. The calendar has flipped over to another year, but a lot of the stocks that we like a lot of the stocks that are talked about a lot are still dealing with a lot of difficulties, and we still have some economic challenges that may be coming ahead of us. So, you know, this is still a great opportunity for us to build wealth and for us to make building wealth a priority for our lives. So for all the supporters of the Trade for Yourself podcast, I appreciate you for coming back again to another year, like listening to me for an entire year, coming back again. All the new people that are coming on board, I appreciate you as well. So let's go ahead and get right into it. This episode, okay, is going to be about Apple stock. Okay, it's going to be about Apple stock. And, it's something that we need to think about in terms of what price should you pay for Apple stock? Okay, what price should you pay for it? Now, of course, disclaimer, I am not a financial advisor, nor am I a fiduciary. Investing comes with considerable risk. Make sure that you seek out financial help. Everything that I talk about is only going to be for informational purposes only, in order to give you all just my thoughts and kind of what I'm thinking in terms of Apple stock. And so to get started in this episode, I want to share my screen. Okay, I want to share my screen, and I want us to look at this article from CNBC, because Apple stock has been in the news. Okay, Apple stock has been in the news. And so first thing I want to do is I want us to look at this article from CNBC. And so Apple's market cap falls under $2 trillion as the sell-off continues. Now, Apple shares fell more than 3% during intraday trading Tuesday, giving a market value under $2 trillion for the first time since May. Apple first hit that valuation in August of 2020 as the pandemic boosted sales of products for remote work and school, and it briefly hit a $3 trillion valuation in January of 2022, right? And so the company was trading near 3 trillion, hit it rough, pretty much hit 3 trillion, and then came back down and fell under 2 trillion. So you could technically say that the stock has pretty much lost about $1 trillion in value in terms of prices that the stock has actually traded at. And so let's put a little bit of this into context. And so, like we said, Apple fell more than 3%, fell under 2 trillion in terms of market cap, and Apple fell 3.74% to a price of $130.20 per share, a 52-week low, giving the company a valuation of 1.99 trillion at market close on Tuesday. Now Apple has struggled with iPhone 14 Pro shipments during the holiday season because of COVID restrictions on its primary factory in China. Investors are also wary of rising interest rates and declining consumer confidence, which could hurt demand for Apple's premium price products. A recent report from supply chain analyst TrendForce said it saw Apple's iPhone shipments declining 22% in the December quarter, and Apple has told suppliers to make fewer components for products, including AirPods, Apple Watch, and MacBook laptops, according to Nikkei. Now, I have reservations about this comment, pretty much saying that Apple has told suppliers to make fewer components for products, including AirPods, Apple Watch, and MacBook laptops. I don't quite believe that, because this did not come from the company itself. The only thing that I believe in terms of slowing demand from the company is what the company said on its previous earnings call. And on the previous earnings call, the company said that revenue will probably be lighter in the holiday quarter, which is the December quarter, and to expect Mac revenue to be below trend, but pretty much be below expectations. And so when you start having these stories come out about Apple telling suppliers what to do and what not to do, Apple is typically not going to come out and just divulge that type of information. Like they're going, like a spokesperson from Apple is going to come out and divulge that type of information. You're not going to hear from other people, like other reporters, that Apple has told suppliers to make fewer components. I just don't believe that. That's just me personally. Could it be true? We'll see. We'll see when the earnings report comes out later on in January. But as of right now, I am not inclined to believe that statement. Now, Apple is the last big company to give up its $2 trillion valuation. Previously, Microsoft hit the $2 trillion mark, but retreated from it in 2022. The broader market was down on Tuesday with the S&P 500 index falling nearly 1% during trading. In 2022, Apple underperformed the S&P 500 index, which declined more than 18%. Apple's share price fell nearly 27% in 2022. So let's just take all this stuff into consideration, okay? Apple has been dealing with a lot of issues, right? I don't know of another company besides Tesla that has dealt with the amount of negative press and the amount of negative news that a company has had from November up until now. The company has been dealing with massive issues, but just because the company is a quality company, right, it doesn't mean that it's not going to deal with issues, right? And so let's go back to what I just said, quality company, right? Let's just say, for the sake of argument, let's say that Apple is a quality company. I've talked about Apple before on the Trade for Yourself podcast. Please go review previous episodes and see what the company has coming down the pipeline. And so once we determine that a company is good, it's more so not about whether the company is good or not, because we're only going to evaluate it a few times throughout the year. We're not going to continue to evaluate what it's worth constantly, because price estimates and earnings reports only come out really 4 times a year. Like earnings reports only come out 4 times a year, and analysts only change earnings estimates around earnings reports, around earnings season. So we should only be evaluating companies, you know what I'm saying, during certain periods of time. And so I'm not trying to sell you on how good Apple is or what they're dealing with or things like that, because nothing fundamentally has changed about Apple from January 2022 to January 2023. Nothing fundamentally has changed about the company, right? The environment that we are in right now has changed from January 2022 and January 2023. How investors feel about Apple's stock is different, you know, from January 2022 to January 2023. But really, it's more so about what price should we pay for the stock, because we want to be able to get the stock undervalued. We want to be able to get the stock undervalued and build a position while the stock is undervalued. If we're able to do that and build a position while the stock is undervalued, when we get back into a bull market, that's going to help us get maximum returns. And so since we have went through that article and we know that, now what I want to do is I want to go through the valuation of Apple, and I want us to determine how much is the company worth, right? How much is the stock price worth? Because like I said, we want to pay for businesses, and we want to make sure that they are undervalued when we pay for them. So I've talked about this before, but I want to talk about this again, right? Whenever I value a company, I like to use the forward PE ratio to value a company, because I feel like it's very, very simple to understand. You know, if you wanted a more like clean and crisp valuation in terms of like, you know, very, very accurate, you would probably want to use a discounted cash flow mechanism, a discounted cash flow calculator to pretty much calculate and discount the future cash flows into the present day based on a certain interest rate. But I feel that the forward PE ratio is good enough because is based on future estimates. It's based on future estimates over a 12-month time span. And so even if you wanted to use the discounted cash flow method to value a company, it doesn't mean that that is exactly what the company is worth. So what I can do is I can use the forward PE ratio as a mechanism for determining what the company is worth, and I can just discount it to provide myself a margin of safety. Because I'm not saying that the number that I have is 100% right. So to give myself a buffer room, I could discount it at certain prices, okay? And that could give me a margin of safety to say, hey, man, I'm really getting a good company at a good price. So the forward PE, which PE is price to earnings ratio, right? The forward PE is 21.2, okay? That is the forward PE ratio. That's that number, right? So for this calculation, what you want to do is that you want to multiply the forward PE, that 21.2 number, times the annual estimates for 2023, because now we're looking towards 2023 estimates to make a determination for what we believe the company can produce from an earnings perspective. Now, earnings per share, we've got mean estimates, we've got high estimates, and we've got low estimates. And we've also got the number of analysts that are performing estimates. So we've got about 39 analysts that are doing estimates for the stock, 39 people. And that's very, very good, because we want to have a high number of analysts working towards the stock. And so you may look at a lot of things on this page, and one thing that you may look at may be the price target, but I'm not worried about the price target right now. I'm not worried about what people are saying the price target is. I'm trying to figure out what is the company worth from an earnings perspective over a 12-month time span, because if I can get the company under that number, then I know that I'm buying it at a good price. So at the top, so right here in blue, right here, this is Apple. This is Apple versus all the peers that they have in this article, right? We're going to take the 21.2 and we're going to calculate this together, right? I'm going to go through this with y'all in real time. So we're going to take the forward PE. The forward PE number is 21.2, all right? We're going to multiply it times the mean annual EPS estimate for 2023. I don't want to do the high. I don't want to do the low. I want to be right there in the middle so I can get an average of all. Multiply it times 6.203. That's going to give me $131.50 based on next year's earnings. Okay. They're saying that Apple is worth $131.50 right now. Now this is also what I want to look at too before we go to the chart, because we have this number, but now I want to go to the chart as well. Now, up here in the top right, we have mean estimate trend. Okay, so pretty much this is telling us how are the mean estimates for the company trending. Okay, 90 days ago, the mean estimate was 6.44, was $6.44. 30 days ago, it was $6.24. Today is $6.20. So the percentage change over the last 90 days has been negative 3.7%. So pretty much people are expecting estimates to continue to go down right now for the company. And that's what Wall Street is pretty much expecting in general. They are expecting analyst estimates to trend downward because of the anticipated recession and what the company has to go through. And so this is not like as far as like the trends, this is just something that we want to pay attention to. We want to pay attention to the trends, but what's going to be very, very important is this next earnings date, right? This next earnings report date on January 25th. That's going to be extremely important because that's going to provide us more information about what the company is actually doing right now. How did they actually do in the holiday quarter? Did they do as bad as what everybody is expecting them to do in the holiday quarter? And what can they tell us about demand? And what can they tell us about what the company is expected to do in the following quarter. So since we've got all that done or whatever, now I want to go to the chart now, because me personally, I'm the type of person to where I like to combine fundamentals and technicals, because if you combine fundamentals and technicals together, you can put yourself into a very, very good position to be successful as an investor. And so, we went through the forward PE estimate and we went through the earnings estimate. Okay, I have a drawing set, and the reason why I like this set and this is TradingView, guys, and the reason why I like TradingView is because I can set different drawing sets for multiple things. A default setting, I've got a valuation setting, I've got a trading setting, I've got a moving averages setting, I've got a margin of safety setting, right? I've got all these different settings. And so I went ahead and created a valuation set for every single stock that I own, or every single stock that I might want to own, or that I might long to own. So I already know what the company is worth. Okay, I already know what the company is worth going into this situation. So like I said, $131.50, that is fair value based on the estimate that we just made, right? So I'm gonna go ahead and plot that. $131.50. Okay, and there's a reason why I have this chart up, okay, because I want to look at the fundamentals and combine them with the technicals. Okay, so we're just going to mark this as fair value, right? We're just going to mark this as fair value. Okay, that's what we're going to do. We're going to mark this as fair value. So hypothetically speaking, if you do not own Apple stock at all right now, hypothetically speaking, if you bought a share of Apple today, or if you buy one tomorrow and Apple stays at the exact same price of $126.36, which is the price that it closed at today, you would technically be buying it undervalued based on the metric that we just went through, right? Now, a stock is not going to be trading at fair value all the time. Sometimes we could be right, sometimes we could be wrong, because things can change instantly, right? Because like I said, what's going to be very, very key is going to be the next earnings report, because that's going to give us more clarity, and we're going to get even more revisions from an earnings perspective. But let's not worry about that right now. Let's just take this fair value number, okay? Like I said, I don't know if this is 100% right. This could be partially right, but it may not be 100% right. So what I want to do is I want to discount it 10%, right? The first thing I want to do, I want to discount 10%, right? And so if I discount it 10%, that's going to put me at $118.35. Now, $118.35. And I'm going to call this 10% margin of safety, right? And pretty much the 10% margin of safety is technically a 10% discount, because I'm discounting the fair value number by 10%. Okay. I'm discounting the fair value number by 10%. That's a 10% margin of safety. Okay, let's do a 20% margin of safety. 20% margin of safety, that puts us at about $105.20. That'll put us at a 20% margin of safety. And just so we can go ahead and get on the chart, so I don't got to put it on here anymore. Let's go ahead and mark off a 30% margin of safety just to see where it would be. Where would a 30% margin of safety be? And I think a 30% margin of safety is probably a worst case scenario in terms of where I think the stock is actually going to come down to, right? Because we really just want to have these as possibilities, right? Because anything can happen at any given time in the market. Like we don't know what could happen at any given time. So there's nothing wrong with us plotting these numbers and seeing what they are. So, like I said, right now, so since it's undervalued, so let's go back first and let's start this thing first, okay? Like I said before, if you don't own Apple stock at all, right? You don't own Apple stock at all. Based on this metric right here, it would be okay. Like I said, I'm not a financial advisor. This is not financial advice. Based on this fair value, it would be okay if you bought shares of Apple right now, right? I wouldn't necessarily say that you would pretty much do your full position at 126, but it's a good price to start based on the fair value. Now, we're looking at the fair value, but we also have to put the technicals into perspective as well. Now, me personally, I do believe that Apple stock does have more downside to it. I do believe that. I believe that Apple stock has more downside. I believe the market has more downside as well. It's just I'm not trying to time the market. So I'm a person that I say, okay, what is the stock worth? I'm the type of person that's like, okay, what is the stock worth? Okay, what is the stock worth? And I can say, okay, how can I discount the stock? And then when I discount the stock, I will establish those as prices that I'm comfortable with owning the stock at, right? It doesn't mean that once I buy it at 126, it's going to go back to 150 or 175 or 180. That's not what I'm saying. I'm trying to buy a quality investment that I'm trying to hold over a 3 to 5 year period, right? I'm not trying to hold this for 6 months or hold it for 3 months. It's not what I'm trying to do. If that was the case, I wouldn't even be making these calculations right now. So let's see. Okay, let's put into perspective, how much is the stock price down? The stock price is down about 31%. Okay, the stock price is down about 31% from its all-time high. So let's look at some, pretty much let's look at some support and let's look at some resistance. So this 10% margin of safety coincides pretty much with a pretty good level of support. It coincides with a level of support. The 20% margin of safety also coincides with another level of support. And the 30% margin of safety also coincides with another level of support. So you got these 10% margin of safeties that we're discounting right in line with areas of support. Now, this 10% margin of safety, $118.35. Remember that, guys, $118.35. Let me go over to my margin of safety drawing set. Now, my margin of safety drawing set has my Fibonacci levels on it, right? My Fibonacci levels on it give me, pretty much potential support levels. Now, the 50% Fibonacci retracement level indicates that the stock is half off, right? That's pretty much what it means. A 50% Fibonacci retracement level indicates that the stock price is half off because we draw it from the all-time high and we draw it to a major low. I would feel very, 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 very good about buying Apple at the 50% Fibonacci retracement level because it's a possibility that the stock can hold right here. And this 50% Fibonacci retracement level at $118.04 is right in line with the 10% margin of safety that we discounted from current fair value, right? This is current fair value based on estimates. And so when you look at this situation, what price should you buy? What price should you pay for Apple stock? In this environment, and pretty much in this environment right now, number one, in this environment and based on the fair value, you shouldn't pay more than $131.50. You shouldn't pay that if you want to get the maximum value. But this 10% margin safety, this $118 level, that's a very, very good level that I would definitely feel good about, if you want to buy a position and start a position. Now, here's the thing. That's $118. That may be a level that you may be comfortable holding the shares at. Let's say, for example, you're okay holding the shares there, but the stock continues to go down. You have to ask yourself this question. Ask yourself, okay, how long do I want to hold this company? How long do I want to hold these shares? Do I want to hold these shares for the long term? With that being said, you want to build a position when the stock price is going down. build a position when the stock price is going down. Okay, if you do that right there, that's going to allow you to pretty much get an average price in the position. So let's say, for example, you had a goal of trying to get 100 shares of Apple stock this year, right? Let's say, for example, you had a goal, and let's say Apple hit $118.35, $105.20, and $92.05. Let's say Apple hit all three of these specific targets right here, right? Number one, you're buying it undervalued. So you're not overpaying for the stock, right? The stock price is just coming down, right? Because like I said, the stock price is not going to trade in concert with the value. So let's say you bought 33.33 shares at $118.35. Let's say you bought 33.33 at $105.20. And let's say you bought the remaining 33.33 to round up to 100 shares. Okay. And let's say you bought a third of your position at all of these levels, right? Your average price at that point would be $105.20. It would be right here. Now, let's say that's your average price of $105.20, and Apple was able to give you a projected stock price increase of 100% over a 5-year time span. That would put your stock price at $210.40. And at that particular point, you probably wouldn't have to buy more shares again if you only wanted to own 100 shares. What I want us all, and let me come off of screen right here, because I want you guys to come back and review this, look at this, do your own analysis and everything. Let me come off of screen here and let me just tell you all what I really truly feel in this environment, right? Now is the time for you to really truly determine, okay, what type of investor do you want to be? Okay, do you want to be a growth investor? Do you want to be a dividend investor? Okay, what type of time horizon? What is your time horizon for being in this market? Because right now, technology not out of favor. Technology is out of favor. Consumer discretionary is out of favor. Communication services is out of favor, right? 3 sectors, right, where 25 to 30% of the S&P 500 is located in those 3 sectors, right? I can name the companies, we already know them. The point is that that's where the growth is, right? Because when the market turns, okay, the market is going to turn back to what? Turn back to quality. It's going to turn back into quality, but beating up quality. Go back to what I said prior. Nothing has changed fundamentally about this company, Apple stock. Nothing has changed fundamentally from January 2022 to January 2023. I promise you, nothing has changed fundamentally. The only thing that has changed has been the environment that we have been in and how investors feel about the stock, how they feel about what's happening. That's the only thing that's changed. And so the main goal that I want people to have during this bear market is to build positions in the bear market. This is what's providing us the opportunity, because I don't know when we're going to come out of the bear market. We may not come out of a bear market until 2024, simply because the market still has to go through cycles. We don't know what's going to happen with the economy and in this environment, right? Because there's so many different things. Inflation, I can go on and on and on and on. But me personally, I would much rather be building positions in a bear market than building positions in a bull market. Because in a bull market, you may not get the opportunity to buy a quality company like Apple 10% undervalued, 20% undervalued, right? And these are just based on current estimates right now, based on the environment. 6 months from now, we could have a totally different valuation on Apple. We could like 6 months from now, we could have a totally different valuation on Apple, and Apple could be trading at a totally different stock price relative to that valuation, because the market's going to price things in. It's going to continuously price things in from a forward mechanism. It's a forward mechanism. So the market is always working. When you see stock prices going up and down, that is literally a visual representation of money working, price buying and selling and things of that nature. So yes, does Apple probably have more downside? It probably does have more downside to it. But the one thing I want to tell you is that I would rather be building a position on the way down than building a position on the way up. If I do it correctly, and I work hard enough and I focus enough, I can put myself into a position to where I build a position in a bear market. Like I build a position in a bear market and I never have to worry about buying the position again because I bought at such a good price. Again, this is the first episode of 2023 for Trade for Yourself podcast. Happy New Year. Thank you all for tapping in again. You know, this year is going to be about providing you guys the meat, providing you guys the potatoes, if you will, like really truly giving you what you need, like just giving it to you what you need straight, not trying to go, all over the world, just give you everything that you need, right? You may see some shorter episodes from me, maybe 10 to 15 minutes. And that's because I want to give you everything that you need very quickly. That way you can make an assessment for it, because I want to give you maximum value and give you what you need. And then, just give it to you on a high level, give you exactly what you need. And then we can break it down as we go on. Again, thank you all. Thank you all again for tapping in with another episode of the Trade for Yourself podcast. Remember, don't pay for it. Trade for it. I'm going to tap in with